Hello, hello. Welcome to October. It is trick or treat month, and we are having some Halloween fall fun with our content today. Might not be fun for everybody, but it is fun for us. Um, and we're gonna be talking about 7 spooky skeletons of indexed universal life. Now, we have to say that this is not going to be everything and anything that we could say about indexed universal life, that we could probably say more. We could get into more details. The purpose of today is to give you a nice, ideas, overview, things to think about, and then you can follow up with asking questions of financial professionals, looking at alternatives, doing your own comparison, all those kind of things. But we wanted to make sure that more and more people were aware of kind of the flip side. There are lots of people out there promoting Index Universal Life. They're doing it on YouTube, they're doing it door to door with their friends, with their family. And we wanted to put a voice out there that gives a historical perspective, a grandma perspective on Index Universal Life, so that there people can get kind of both sides of the story, not just what they're hearing promoted out there. So we're going to do that today. Brandon, why don't you do a little bit of housekeeping before we actually jump into these seven scary skeletons or spooky skeletons of IUL?
Yeah, and I think there probably won't be as many people on today because it seems like, oh, you're talking about IUL, like life insurance, of course, but maybe. And I really want, as you guys engage, we've been creating content because these are things that people bring to us and talk to us about, and we felt it was important for us to, as I don't know, people, just in general, good people. We want to make sure that we are helping not just our clients avoid pitfalls, but you as well. And really, that's part of what we want to accomplish here. It's about helping you break through to a smart, stable financial future, and actually bringing it with a little bit of fun with, Halloween. And all that stuff. So thanks again for joining us. If you listen to this video, hit that like button, share, put some comments. I'd love to hear. And I think, Amanda, we got in the spirit of Halloween. It's now literally fall. We got a pumpkin today, I think, right?
Yeah, our son had a field trip to a pumpkin patch, pumpkin farm, and he brought a pumpkin home in his little backpack, and it's officially fall. I'm excited. I do want to say one quick word of warning. We have and by the way, Brandon, I don't know if your headphones are working. I can hear feedback of myself.
I don't think it's me. I hear you in my head. Yeah.
Okay. Okay, I'm just hearing myself twice. Okay. What was I saying? Oh, sorry, I got distracted by that. There's a link in the description of this video to a Disney song from way back in the day, black and white, skeletons dancing, and the word of warning is it will get stuck in your head. I found it earlier this week, and I've been singing it to myself. Spooky, scary skeletons. It's really catchy, as you might expect from a Disney type production. And actually you can see a little bit of how Disney will repeat the same thing with different characters. They'll do the same dance and stuff like that. You can see some of those roots of some of those dances that you see later on in other Disney productions in how these skeletons dance or whatever.
I mean, I was thinking more Danny Elfman and Batman kind of music, kind of stuff. Tim Burton.
Oh, okay.
That's more what I was. Whenever I hear that, I'm like, oh yeah, there we go.
That's your flavor of Halloween.
Yeah, Tim Burton and Danny Elfman, which you probably have no idea who that is, but
I know Tim
you
Burton.
you've
Isn't
heard Danny Elfman too.
I have. I know that name. Where would I know him from?
Lots of music.
Okay.
Any kind of creepy music, probably he did it.
Okay. Um okay, so should we jump into the 7 spooky
Yep,
skeletons?
for sure,
Okay.
for sure.
Oh, and one thing to be aware of is that Index Universal Life has only existed since 1997, if I'm remembering that correctly. So grandma would not have had Index Universal Life back in her day. Um, and but it is built on life insurance, which grandma knew and used and had. And so and it's um they're like it's still money, right? It still works the
Mm.
same way. So some of like the grandma type perspective we're going to apply to Index Universal Life. Okay. So first spooky skeleton is skewed illustration values. So here's my biggest thing. I have people send me, hey, I'm talking to this life insurance agent and they're showing me Index Universal Life. And can I send you the numbers and get your opinion on them? And when they send me the numbers, it's not an official illustration. It's copied and pasted some numbers from some illustration into some kind of software program that then adds like graphs and charts. And they're just showing, and in fact, one of them literally said, we are showing you things that we can't show you in an illustration.
Really?
Yeah. The Index Universal Life illustrations, just like all life insurance illustrations, have to go through a compliance. They have to be approved. They can only show certain things, and they're not allowed to vary up those certain things or to be compliant illustrations. And the interesting thing about illustrations is they're just illustrations, right? They're like a Disney sketch, right? They're just showing you what could happen, but they don't ever happen exactly as illustrated. There's variability that can happen. So, um, what I've at least seen when people will send me the proposal that they're looking at is that they're not even seeing the full illustration, the compliant one. They're seeing this take that this agent has given them that hopefully like helps them understand it better is like the idea. But sometimes I wonder, is it? But when you look at a real true compliant Index Universal Life illustration, they show you multiple sets of numbers. They'll show you guaranteed numbers, a midpoint number, and then a higher number with an assumed interest rate.
Mm-hmm.
And what's interesting with these is that they're all showing you how they might perform, what could happen. And that the mid, so the zero or the guaranteed is like if the market is down every year or at zero every year, here's guaranteed what you would get. And then the midpoint is assuming a certain interest rate, and then the high point is assuming a certain interest rate. And the problem is that they put that same interest rate every single year. So whether it's 3% or 5% or 9%, they're saying we're assuming that your indexed values do that amount every year. And the fact is that the market doesn't do the same thing every year. It never will. It can't, right? It goes up, it goes down. It sometimes it goes up a lot, sometimes it goes up a little. So it's actually like really misleading to show someone the same percent every single year. Now there might not be an alternative to that, right? In terms of if you showed the market up 10% and then up 5% and then up 15% and then up 2%, right? Like then you wouldn't have any standardization. But you just have to be aware of that what they're showing you is a straight line projection, right? It's showing you the 5% every year going up when really you're going to do a little bit of this, right?
Or a lot of that. Who knows?
Right.
That's the problem. We don't know, and that makes it a little more challenging. and then competing against that kind of thing,
Mhm.
it makes it even more difficult because they're not based in reality.
Yep. So you have to be aware of that they're projecting an interest rate every single year on your indexed values and what happens to them. Okay, so that's the first spooky skeleton. You can also like question if they show you 8% or more, does the market actually do that on average? But that's a different conversation or slightly different.
Well, and I have seen some illustrations where it is interesting what they put in there, and you're like, I don't know.
No, so those like compliant numbers have a maximum they're allowed to show you, and they can't go over that maximum. Interesting. Okay, next spooky skeleton, scary skeleton is stepping up of costs.
What does that mean?
Yeah. So there are a lot of different fees within an indexed universal life policy. Let me tell you a few of them. Insurance charges, because you are buying insurance, policy
Mhm.
charges, transaction charges, policy issue fees, premium fees, and if you have any special riders, the cost of those too. Lots of different fees. And those fees can change. They can increase them. Now they can't just like single you out and increase your fees. They have to increase the fees for everyone, right? But they can still increase the fees and the costs associated. And then and there's two things that are very common here. And we've seen this in the last couple years with such a low interest rate environment and how lots of life insurance companies use uh, products that are safer. They're more in
Mhm.
terms of like their life insurance. They have to be able to pay out their death benefits. So they use safer products to grow their portfolio, and those are more sensitive to interest rate adjustments. And we're in a pretty low interest rate environment. So what we've seen in this is that lots of indexed universal life policies and the companies that offer them have been increasing fees a lot over the last couple of years so that they can actually make money and pay out their death benefits and give you the interest that they're telling you they would give you and stuff like that. And then the other side of it is even if they don't raise those fees, even if because of that, they've got to make sure they can fulfill all their obligations and stuff, they could still raise the cost of insurance. Often with these policies, you're buying 1 year term insurance as the life insurance side. And every year that renews, they can raise the cost of it. And I can't tell you how many 70-plus-year-olds have started coming to us and saying, help, they're raising the costs within my indexed universal life policy, and I can't afford this anymore, but I still want life insurance. I still need life insurance. And they've been paying for this policy for a long
Yep.
time, and they're going to have nothing to show for it within a couple years.
Yeah, and that happens a lot actually when
And it's
we.
happening more and more.
Yeah, and the hard part is we see as we're working through people. We have the 70-year-olds coming to us, and we have the 30-year-olds coming to us, and you're like, oh yeah, this is not gonna work out so well. I feel like I'm seeing into their future, which is kind of spooky there too. But seeing into their future, knowing what's going to happen, even though, again, we don't know, but I have a pretty good guess
Yeah.
that
And
costs will go up.
yeah, and some 20, 30, 40-year-olds say, well, I'll just start this indexed universal life. I'll take care of the good years while the costs are low for the life insurance part because I'm young. And then I'll transfer it to a whole life, a traditional whole life insurance type policy when before they raise the costs on me.
Yep.
And the thing is that then you still have to be approved for life insurance. You better hope that your life or your like health doesn't change, right? Things like that. So be very cautious if that's what you're counting on. And remember that even in the middle, all those other kinds of fees and charges they can adjust that aren't tied to your health or how the cost of life insurance to insure you. Okay.
Gotcha.
Number 3. So one of the things that this one is small print of when guaranteed interest is credited. And this one was like a surprise to me. So a lot of
and you're in the industry, so you
right. Yeah. So a lot of what people count on when they're starting an IUL policy is that there is a guaranteed interest that they can get even if the market goes down every single year or grows very slowly. They get, sometimes it's 1, 2, or 3% guaranteed that, even when the market goes down or is flat, they're going to get this. However, they don't get that 1% every year or the 2% or 3% every year. It is often only credited every 5 or sometimes even 10 years later. So you can imagine this. If you put $100 in your savings account and they told you we're going to give you 3% interest on that, but we're not going to put that interest into your account until 5 years from now. Over the next 5 years, you've got $100 just sitting there and it's getting 1% interest, but only on that 100, right? Whereas like savings accounts, the way they really work is you put that $100 in, you get that 1% interest each month. So then you might go up by a penny, right? Like little bits over time. But after 5 years, you'd have a lot more because you've got that compounding effect going where you're getting interest on your interest. Well, that's like the first way is how the guaranteed interest rate works, whereas people think it works like the savings account works. So read the small print there, really figure out when does that guaranteed interest get credited. And remember that the fees are still coming out every month. They're not coming out every 5 years or 10 years. They're coming out every single stinking month. Okay.
Which, again, they're a business model, so they want to make sure that they're profitable. So.
Yep. Okay, ready for number 4? Shortfall of NoLapse guarantees. This is another part of Index Universal Life that people count on, is that there's a NoLapse guarantee that that they'll still have a death benefit, and that NoLapse guarantee will make sure that that death benefit is there. And this was one of those things that I had to really read really carefully, a bunch of illustrations, and I even had to call along with a client, their Index Universal Life Insurance company, talk to customer service and try to get a clear answer on this, because it looked like their NoLapse guarantee was in force, but it wasn't clear. And what we found out was that, yes, they had a death benefit in force, and that death benefit had a NoLapse guarantee, but not their cash value. So as long as they kept paying their premium, they would still have a death benefit until that NoLapse guarantee went away, but they wouldn't have any cash value. So they couldn't take any policy loans. They couldn't, cash out the policy and get a surrender charge. They couldn't do a 1035 exchange to a new life insurance policy. There was no cash value there to do that with. The NoLapse guarantee was just for the death benefit side. Big difference. And also read the small print on this one. If you miss a payment or you're late on a payment, you could lose that NoLapse guarantee. And even if you catch up on it, you might not have it in force anymore. They might not put it back on. So just be really careful with that.
Gotcha. Yeah.
Okay.
And these are things even me, as I'm again in this industry, I'm like, holy crap, there's just a lot to keep track of and then explain. Even on our simpler policies, it's still lots to explain.
Yeah, wait till we get to number 7, Brandon. Wait till we get to number 7. Okay, number 5, shifting of risk. You have to remember, you put that label up wrong, Brandon.
Yep.
You have to remember the definition of insurance. You buy car insurance to shift the risk of you getting into a car accident to the car insurance company. So if you get in an accident, they're taking on the risk. They've got to pay the claim up to the certain limits of your policy. You buy home insurance to shift the risk that your house is going to catch on fire, or you're going to have a burglary or a flood if you have flood insurance and are lucky enough to be able to get that. Like you buy health insurance, but home insurance to shift that risk. Health insurance, right? The risk that you're going to get sick, you're shifting that to the health insurance company. Life insurance should be about shifting the risk that you die too young to the life insurance company.
That's the point of it.
That's why it was created, which we're going to have to do as this like whole skeletons thing that we're doing the theme this month, to go back to like why things were created is very important, because life insurance was originally created to protect widows and orphans, to help cover burial expenses and to provide for your family when you're gone. And that can be for, a widow when you're in your 80s and 90s, or it could be for young kids when you're in your 30s, right? Like life insurance is important in different ways to shift that risk throughout your life. But with indexed universal life, the risk is actually getting shifted back on you. Think about it. The life insurance company that you do an indexed universal life insurance policy with is going to get their money. They're going to charge you the fees. If there's anything guaranteed in indexed universal life, it's for sure the fees, right? But you don't know what the market's going to do. You don't know if you're going to be able to pay the increased premiums when the cost of the insurance goes up. You have very little control over whether you're going to be able to actually keep that policy from lapsing. And a lot of these policies don't have any kind of non-forfeiture option. So you can't make sure, like you can't reduce pay up the policy or do premium offset to help make sure that your policy doesn't have you. Sometimes they'll let you buy extended term insurance with it, but if you don't have any cash value there, that's not going to be an option anyway, right? You like that risk of the policy lapsing and you losing everything. You're basically paying to keep that risk on yourself. That if you can't keep paying the premium, you can't meet those costs, that you lose all that life insurance that you had for however long you had it. That's a pretty big deal.
And again, we're seeing this in play in a lot of older people's policies. They bought it in the 80s.
Nope. They bought it indexed universal life in 1997. 90s. They bought it in the late 90s or early 2000s, and they've had it for 20 years now, and they're seeing the actual reality of it. Yeah.
I am seeing that. You're right, 90s, not 80s.
Okay, you ready for number 6? This one also gets my goat. You ready for this?
Uh-oh. It gets your goat?
Gets my goat.
Do you have a goat?
I don't have a goat. The insecurity of risk or of loans. I had to I'm trying this S theme. I had to add an IN before my S for this one. The insecurity of loans. When you take a policy loan from an indexed universal life insurance, it seems like a beautiful thing. They're going to charge you a smaller interest rate. Hopefully you're going to get a bigger growth within your policy. It sounds really good. The problem is that you're still having the cost taken out. So even let's say they charge you a 5% policy loan interest rate and you're getting 8% in the market, you think you're making 3%, but you still have all those fees. And so you're not really making 3%. And this is one of the things I heard. I need to do a little bit of more research on this. So fact check me on this side of things. When you take a policy loan, normally with life insurance, it's your death benefits that's the collateral for that loan, right? And that's what would pay back your loan. And what the life insurance company actually does is take the cash value that loan represents, and it kind of takes it off the books, keeps it in a safe place so that if you don't pay back that loan with the interest
Hmm.
that they charge you, they've got the money still. I'm not 100% sure if that's what happens with an indexed universal life policy, because they need to give you that interest that's based on the index that you're following. And it might not be in as safe of a place when you take a policy loan. So, two different things there to remember. The fees are still being charged even when you take a loan. And they might not have the same kind of backing of that loan in terms of what they do with their general fund. So think about
Gotcha.
those things. Okay,
Gotcha.
and then number 7 is the biggest one for me. We ready to go to number 7?
I'm ready.
Okay. Suits, as in lawsuits. This is a really big deal. If you just Google indexed universal life lawsuits, you're going to see a whole list of different companies being sued for different reasons all across the country. Um, they Now that these policies have been around for 20 plus years, the lawsuits have started. And what is happening in a lot of cases is that these clients are saying, this is not doing what my agent told me it was going to do for me. Uh, this was not explained to me correctly. In fact, my agent misrepresented. What I'm learning now, he was pretty much a straight out lie. And so they're suing the life insurance company, they're suing the agent that sold it to them, because they're seeing like, this is not doing what I thought it would do. And that that's costing the companies a lot of money. It's costing the agents a lot of money, and it's costing the person suing a lot of money too. Because remember how we talked about the illustrations in number 1?
Yep.
Within that illustration, 40 plus pages, there's going to be a page that uh, that the insured, the person starting the policy, and the agent both sign, that says that they understand everything in the illustration. They understand how the policies work. And when you buy an index universal life insurance policy, you are signing that page. You're saying, I understand this. Almost like you're buying a car and you have to sign a page that
Hmm.
says, I understand how the motor works, right? And also the agent is saying that they've explained everything to you and insured and made sure that you understand it. And people are saying, I didn't understand it, comes to find out. But because they signed it and they said they agreed to all these things, the lawsuit is basically falling short. But can you imagine how frustrating that would be, to buy a car and think it's going to get you from point A to point B, and that trust that the motor works and it's going to, arrive at point B in exactly the way that you wanted it to. And then you get halfway down the road, or you're almost to point B, and it just stops working.
Sounds like a lemon right there.
Right. But if that's been like 20 years ago and you signed a piece of paper saying, yes, I'm buying this car as is, I understand that it is a lemon and the fees are gonna go up, or it's gonna run out of gas if I drive 100 miles, then you've got no remedy. You're stuck on the side of the road with nothing to show for it.
Yep.
Um, and then you wouldn't try a lawsuit, but people, pretty important. And in fact, there's been so many of these, there's been so much talk about it, that state department of insurances, I know New York State and I think one other state, the Department of Insurance, the people that control all the insurance within that state, are issuing warnings, like issuing public notices. Beware of what you're getting. Make sure that you understand it. You are signing this piece of paper that says that you understand it. Be sure you really, truly do.
And then the hard part is that makes us look bad, right? And again, if I look up Banking Yourself, and I'm a Banking Yourself advisor, I
Professional.
will
Bank on yourself,
professional, yeah.
professional.
I will see that there's people who are using that term and selling this kind of product, which even again, we go into a lot of calls with the Banking Yourself team, and they are strongly against doing a lot of these kind of things. Like they are um, they don't like it. Like this is where we learned a lot of this stuff. But yet, if you go on YouTube, you'll find people who are saying, "Well, do this and that," and oftentimes it's us trying to beat the system and saying, "Well, we get this or that," and for me, I think I like the guarantees. I like the stability of it, so then I can do more within my own cash flow or business. Um,
Oh, yeah.
yeah, and I think that's a bigger thing than trying to time the market, do whatever, all this other stuff, and it's kind of mixing two different crazy worlds, which I
Yeah.
don't like.
So that's where we have to go back to the why was indexed universal life started. And
Hmm.
in 1997, I think, in high school at that point. I think you were too. Maybe I was in junior high. Um, like we weren't in this industry. We don't really know the why. But as we look back through history, we see the kind of evolution of life insurance. And we've talked about this before on our podcast and here on the YouTube channel about in the 80s, there was a bunch of folks, life insurance agents that went door to door and told people who had whole life insurance policies that they were paying too much and they needed to cash out their policies by term and invest the difference. So if they had been paying $200 a month for whole life insurance, they should buy term, pay $10 a month, and put the other 190 in the stock market. And that's what they went around doing. And then they figured out, well, we don't want to just sell people term insurance. We want to help them with their investment side too and make the asset under management and that kind of thing. But then that gets complicated being a life insurance agent and um, an investment advisor. And so they started figuring out how they could merge the two. And also within the tax code, there's a lot of tax favorability of life insurance. And they wanted to be able to do this investment side and still have the tax
Yeah.
safety, where it grows tax deferred and you can access it tax deferred. And so they came up with this. It's almost like a Frankenstein of adding investing and life insurance together, piecing these parts together and creating this new thing called Indexed Universal Life. And I don't really know their intentions. I don't really know, if what they were trying to do, but it seems like they were more interested in helping people get their money into the stock market or get their money following a stock market or having promoting that way of doing things. And then just having life insurance on the side or using it just for those tax purposes. Whereas there's some really interesting things that happen when you think of life insurance is primarily to protect widows and orphans,
Hmm.
but I want to use it within my lifetime to do things like buy cars or do real estate investing or maybe do buy some stocks or some cryptocurrency when I want to, but I want that solid foundation that's built on savings and that's safe and secure. That's a very different way of thinking, right? Building your financial foundation on something that's safe, liquid, accessible, provides protection for your family,
Yeah.
the attributes of most good whole life insurance, and the properly designed bank on yourself type whole life insurance that has early cash value and all those things, and building your financial strategy on term within a side investment to try to make sure you're kind of protecting your family, but it's more about growing your wealth um, in a way that does have some more risk to it and fees and things like that. Very different ways of approaching what it looks like to think how like what you want your money to be doing for you and how you want it to work.
Yeah.
And just because you're calling it life insurance like Index Universal Life doesn't mean that they're one and the same. In fact, they're bank on yourself properly designed whole life insurance and Index Universal Life insurance are more like apples and oranges or apples and cars, right? Like they're so different. They're not actually the same.
But yet you'll see again on the social media or people who are say, "Oh, I could do that. I could do that for you." And again, as we've seen this play out, or people trying to use the policies the way we position it, um, it doesn't work,
Yeah.
uh,
And
and that's gets sad.
yeah, and it's just props to Pamela Yellen and her work with Bank on Yourself. She's the one that trademarked it. She's an amazing woman. She's part of the research that we did to learn about Index Universal Life and how it works. A lot of that came from her. She's had so much success in truly helping real people build real wealth for their families, but also for themselves with to use within their lifetimes, that all these people want to tap into that success, kind of live in her shadow, and so they're trying to do their Index Universal Life thing and calling it Bank on Yourself because of the success that she's had. And
Yeah, the
I just
copycats.
yeah, and it's sad, and we felt like we needed to speak up and share what's really going on here, and how if you really want to do true bank on yourself, where you have something that you can trust is going to be there for you. Like, people trust banks like nothing else, right? They think banks are the institutions, they're going to be here long after churches are gone, long after hospitals are gone. We're going to have banks, right? That's the kind of, like, if you're banking on yourself, you want to have that feeling about your money. It's not going to
Yeah.
get siphoned away by fees. It's not going to get lost when, if the stock market goes down, like in variable universal life, right? That it's something you can trust in,
Yeah.
like
Well,
a lot of people trust in banks.
and when it comes to the whole life insurance side of things, you shouldn't be wanting to die or something along those lines because your thing is going to not pay out in time. Like, a term
Mhm.
policy that, you're like, "Oh, my term is over. I hope I kick the bucket before it does because my costs go up." That is not the best way to live. It's the same with these kind of things, and knowing that the cost is going to go up. If that's going to happen, isn't that going to bring more stress and everything else? Like, and
Yeah.
I wonder again, as these boomers get older, how many more lawsuits and how much more we're going to see. And for the young people who are listening, if you are listening, what's the definition of insanity? Doing the same thing and expecting different results.
Well said. Mic drop right there. Yeah, if you're 30 something or 20 something or even 40 something right now, and you want to hear the true, honest, what will Index Universal Life do, and a 70 or 80-year-old who has one of these policies, ask them.
Yeah, and then ask yourself, why do life insurance agents have bad names or any of this? This is not the same thing. It's kind of like in any industry. There's variations and there's bad of everything.
Yep.
But finding the right people that can do it the right way is the most important.
Yep. And I guess final word of wisdom, life insurance is built on contracts. And the life insurance policy is only as good as the contract that you're signing when you start that policy. And if you were going to sign any kind of contract, right, you would review it. You would look at the fine print. You would make sure you understand what it is you're getting into, because you know how many people have been burned by signing something or entering into a contract they didn't fully understand.
Yep.
So we're just asking that you do the same thing.
And that's one of the things I love about this is signing. When I sign with our clients, we do sign, and there is a guarantee there that I feel confident in.
Yeah. And there's non-guarantees that we feel like we've explained and people understand well.
Yeah, I feel really good in the non-guarantee side too.
Yeah.
Pretty very well, but definitely I can feel really solid, and I don't feel like a sleazy person or anything like that because I know that I'm doing really well by my clients. I don't have to go
Yep.
backwards and apologize to them 30 years
And
from now.
yep. And if you like Bananas shirts, the one Brandon's wearing today, give us a thumbs up on this video. Be sure you hit subscribe. We're going to be talking about spooky, scary skeletons all month long on the channel, as well as bringing you some fun interviews with some amazing people like we normally do. So be on the lookout for those things, and continue, questioning things, looking at what's, the why behind them. Why were things created? What is really happening with them, so that you can break through to a smart, stable financial future and get that tried and true wisdom that would make your grandma proud.
Awesome. You guys have a great night.